So I'm here today with Reg Hoare, who's one of the managing directors at MHP Communications, who's going to enlighten us on the role of the financial PR. Reg, good afternoon.
Good afternoon, Tamsin.
Thanks very much for your time.
Pleasure.
So can you tell us a little bit about your background and how you ended up doing PR?
Sure. So, well, I've had now a 35-year career in the city, would you believe it? I spent the first 11 years in an investment bank, or as those days they were called stockbrokers, which may be a name that's more familiar to people. And that was kind of prior to Big Bang, and I was a salesman. So my training sort of was through the firm. I spent some time on the old stock exchange floor as a blue button. I then went into the research department for a bit, but I always thought that sales was the most exciting thing. So my clients were basically institutional investors. And I learnt a huge amount during that period because not only did we have Big Bang in 86, we then had the crash in 87. I was then at Warburg's for 5 years during the privatisation era, which was very exciting, doing all those big campaigns, you know, SID and all those things. And then things got quite tough over the ERM exit that people may remember, the sort of precursor to the euro. And then things were a bit quiet and I got made redundant. And suddenly I was kind of, you know, I was early 30s and I was thinking, what am I going to do next? And financial PR was one of those ones sort of vaguely on my horizon as a potential career. And I happened to be fortunate that I bumped into somebody I knew who was a friend of one of my stockbroking friends, and he had founded a financial PR company. And that firm was called Ludgate, which doesn't exist anymore. As these things go, things get gobbled up. And he said, oh, you know, if you're looking for a job, why not come and have a chat with me? And I did have a chat. And he then very sensibly said, why don't you spend a couple of weeks with us and see if you like it? And during that time, I really did like it. And I liked the people and the atmosphere. And it was very different from, you know, a big investment bank, as you could imagine. So as one of my clients subsequently said to me, I've turned poacher into gamekeeper as a result of that change of career.
So what is the role of the financial PR? What do they do?
Well, that's a broad question. And of course it varies day to day, client to client. There's quite a lot of variation. But put very simply, there's the kind of strategic sort of overview in terms of how do I communicate, why am I communicating, who am I going to communicate to, when am I going to communicate. So it's really advising the client around all those kind of subtleties. And then it's assisting them, obviously, with their requirements to communicate at certain points in the year. So the foundation of the whole PR activity is the financial calendar. 2 sets of results, AGM, trading updates, etc., etc.
So in practical terms, day to day, what does it mean? What do you do?
What do I do? So, for example, today I've been working on 1 or 2 things. A couple of them are potential announcements to go out, principally in the new year. So a trading update that probably go out at the beginning of January for a client. And we've just kind of put together a kind of first template before we maybe slot in whether it's good news or bad news. So there's that kind of thing, the sort of, you know, the drafting of the announcements, etc. Then I've also been working on some slides for a results presentation, which is going to come out towards the middle to end of January. And that's a company where there's, should we say, there's a new chairman come in, and he's given some quite robust views about what he thinks about the messaging that the company has relied on in the past. And so we are responding to that feedback with their in-house people, with their in-house team. And so I've been working on that this morning with the client.
And do you agree with his robust views?
I think he's got a good point, yes. Having said that, of course, the reason why the communications have been like they've been in the past is because clearly companies have to report in a particular way, particularly in terms of the segments. You know, that is required under IFRS, you know, that they have to report segmentally. So it's actually quite difficult to then say, well, let's turn that on its head and kind of do it completely differently. And of course, fundamentally, if it is in the first place quite a complex business, as much as you might want to simplify it, it actually is almost impossible to do so if it is by its very nature complex and by its very nature an unusual company. It might be one of only one company that looks like they look like, and therefore people, don't, the shareholder doesn't have anything to compare it with. And so you have to end up explaining it in some detail.
So what makes a really good RNS?
Well, so I think there's probably two different types of RNS we should think about. One is obviously the results one, and the other one is a kind of a trading update or an acquisition announcement or whatever. And over the years, actually, if you look back 5 years, 10 years, 15 years, 20 years, they've evolved really quite significantly. And the best practice now, is very much that we have the highlights page for results, and that we now split those out between financial highlights and operational highlights, and we might even have a couple of highlights for current trading. And then we have the quote, and the quote's a really important thing because that's the kind of the takeaway that you want people to go with, and it's what you also want them to cut and paste into their newspaper articles or their digital blogs or whatever, or indeed into tweets. So, that structure is really important. And also increasingly, I think it's important to, in terms of commentary on expectations, to be able to point people towards where they might find an analyst consensus in respect of those expectations. So we've been encouraging clients to say, well, actually the consensus is on our website, and increasingly companies are putting the consensus on websites, or maybe just refer to what the consensus is, as a footnote in the announcement. And
Why don't more companies do that?
I think it's one of those things where they've been they haven't seen the need to do it, and they haven't been advised to do it. And it's becoming something that actually people are requesting and recommending and proposing.
And
and that's been driven by private investors, actually.
And do you advocate that they should put the figures that they refer to?
Yes, absolutely. And the main reason for that, as much as anything these days, is MiFID, which means that a lot of brokers are only selling their research to a restricted group of clients. And that means if you're not one of their clients, you don't get their research, and therefore you don't, in theory, get access to their forecasts. And so it's becoming more difficult, therefore, to get access to forecasts. And by the same token, there are also now less analysts out there as a result of the consolidation of the market and the difficult trading conditions that investment banks have had over the last 5 to 10 years. And that means with less forecasts, again, less opportunity to be able to get hold of them. So if the company collates the forecasts and puts them on its website, hey presto, you have a resolution to that issue.
You referred to earlier that you were working on a trading update.
Yeah.
And you said you'll slot in the appropriate words when they come in.
Yeah.
How far in advance do you know that it's good news, bad news, indifferent news?
You probably get a reasonable feel from the client, a few weeks in advance. It slightly depends, obviously, on the business model. Because if you're a software company with lots of recurring revenue, you really should be hitting the numbers. It would take something pretty extraordinary. If you've got 60, 70, 80% recurring revenue, to miss your numbers. By the same token, if you're a very seasonal business, it might be quite difficult to see where you're going to end up. And equally, if you're a business that's highly reliant on lumpy one-off contracts, which can fall either side of a period end, again, it might be very difficult indeed. So quite often we might have a conversation with the client, which is along the lines of, how's it going? And they'll go, well, it's quite harem-scarum because we still need to do a number of contracts, before the year end or before the half year end to make the numbers. We think we've got them in the bag, but we need the signed bit of paper.
So you generally have a steer as to what's going on?
Generally have a steer, yes, generally, but not necessarily an exact one, but generally.
So with a client with a nasty profit warning, we're aware of it at 7 o'clock in the morning, hopefully if it doesn't come out late. What's going on behind the scenes? When are you aware of it? When are you writing it? How close to the wire is it? What's going on?
Well, the reality is those sorts of profits warnings actually do tend to all be quite last minute, because quite often the company is down to the wire in terms of the business model and whether or not they know the numbers are going to be good, bad, or indifferent. And they might be highly reliant on that one contract or whatever it is to come in, and therefore there is a rush, a crazy rush, to get something out there, and that is a process which, as quickly as you might rush to do it, it still takes quite a bit of time to corral all the advisors to be absolutely certain about the numbers, because quite often the poor old finance director, is actually quite reliant on collating management accounts from various subsidiaries, and there may be value judgments that need to be made about revenue recognition and so on and so forth, most of which is obviously covered by accounting practices, but there may be some, matters of opinion around it. And that just makes it very difficult indeed. So there's quite a lot of, toing and froing basically going on behind the scenes just to kind of nail down.
So what's the process for you? You'll get a call from the company.
Yeah, we'll get a call from the company, and they either will have written something already or they might ask us to write it very quickly. We then will usually have a conference call, perhaps with the brokers, to get their views on it. Usually we then find that this draft gets kind of recirculated thereafter with comments, that have come in during that meeting, or indeed the various parties might go, well, we'll recirculate it, then everybody comment again. And then eventually a point will come where usually the broker or the nomad, depending on whether it's an AIM company or fully listed, will go, we really need to get this out. So can we try and curtail the commenting and the drafting and actually agree that this is kind of final or near final version? And usually that's the point at which they then seek board approval for the announcement, which obviously is critical that they have to sign that off. Sometimes some of the other board members, quite possibly, in a very serious situation with larger companies, the chairman may well be on the call, a couple of the other non-execs might well be involved. But inevitably, some non-execs, have other day jobs, other activities that they're involved with, and they can be difficult to track down on occasions. So quite often you'll find that there's a bit of time when you're wondering, okay, haven't heard anything from anybody, what's going on? And then obviously the final sign off when everything is approved is down to the nomad to actually say, right, we're happy for this to go out, and then out it goes.
And how long is that timeline?
Well, I mean, typically I would say that takes, 2/3 to 3/4 of a day.
Right. So it's quite quick. It's about a day.
In the scheme of things, it's quite quick. Yeah.
And do you get sleep through the night before?
Yeah. I mean, depends what sort of situation it is. And one's got, over the years, one's got quite used to the.
Yeah.
Yeah.
And what's the biggest challenge as a PR?
The biggest challenge as a PR, I think there's two different types of challenge. One is obviously the client side of things and just the demands around that relationship, either in terms of their expectations of what you might be able to achieve, which may not always be realistic, in terms of either volume of press coverage or what happens to the share price or whether the analysts are going to come out negative or positive, whether certain messages are going to be contained, is all the bad news going to be, included, or is all the bad news going to get ignored? So there's always that challenge of managing their expectations. And there's always the challenge with some clients, more than other clients, just around just the process of getting things done. There are undoubtedly clients who are more efficient than other clients, and that may be due to the complexity of their business. It may be due to their auditors. There could be all sorts of variables, but there can be quite a lot of variation around that, which causes us, can cause us issues. And then on the other side of the coin, there's the commercial reality that we have we're a successful firm. We've won lots of clients in the last few years. That means our number of clients has gone up per consultant. And it, particularly during the results season, it can be crazy busy trying to juggle, timetables, diaries, making sure that we can look after each and every client to the best of our ability.
And where do you place the retail investor? There are some PRs that really do not want any retail investors at any meetings or any sort of contact at all, and there are others that are more open. What's your view?
Well, I've always been very open to it because I'm a retail investor myself, and always have been, and therefore I've always had a kind of strong commitment to including retail investors into, company activities. And the reality is, the way the market has evolved particularly in the last 5 to 10 years, is that actually retail investors have become a much more important component of a company's shareholder base. And particularly for smaller companies, and when I say smaller, sort of sub $500 million market cap, they can actually be quite a significant provider of liquidity and capital, to a company, and therefore a really important audience for companies to respect. And I think most companies are now beginning to get that message and to understand and realise that actually they need to cater for that type of shareholder. And obviously, as technology has evolved, for the retail investor, it's much easier to trade on your own account and to trade, in quite significant size, given that we know that there are plenty of ISA millionaires who are now out there because of that tax regime that's been available to us. Obviously, SIPs have made everything much more flexible as well. And again, those are the significant sums of money held in SIPs. And we can all trade these things on platforms. So I think it's a really important, group of people to look after.
So how do you gear your comm strategy in order to serve the retail investor?
Well, generally speaking, we'll advise companies to, one, make themselves more user-friendly, and that can be, providing consensus forecasts on their website. That can be commissioning paid-for research from somebody like Equity Development or Hardman or Progressive. Equally, it can just be making sure that there are events which those retail investors can come along to, whether that's one of the equity development forums, whether that's a Mellow event or a ShareSoc event. All of those now provide fantastic opportunities, for companies to go along and tell their story, to that audience. And the great thing is about that audience is you don't just get, 5 people turning up or 10 people, you get 50, 60, 70, 80, and potentially more turning up, and they're very engaged. They ask fantastic questions. Actually, sometimes the questions they ask, really put the analysts to shame. So I think companies are realising that, they need to, to look after that audience.
And of course, this video.
Yes, the video. I forgot the video. Absolutely. Digital content, very important factor.
So let's talk a little bit about regulation. So there's various forms of regulation that a company has to adhere to.
Yeah.
Can you tell us a little bit about them?
Yes, it's become a minefield for companies. It used to be very lax. Going back to when I started, it really was very lax. And there used to be what was known as selective briefing. So quite often the analysts from the house broker would get a call from a finance director effectively saying, here's a profits warning, can you downgrade us? Put a note out tomorrow morning. And that was kind of how the market operated for years. And the FCA sort of eventually thought they better do something about this. And so the disclosure and transparency rules kind of evolved out of that. And those are the rules that we now all kind of have to adhere to. And essentially what that means is if you've got some news, you've got to announce it to the market. And you've got to announce it, first of all, straight away. And secondly, you've got to announce it universally. So you can't have a selective briefing. You've got to stick it out on the RNS system so that everybody gets it at the same time. And preferably that's on your website as well at the same time, so that nobody can claim to have heard about it first.
So sometimes there's a sneaky downgrade to brokers' forecasts that hasn't really seemed to be RNS'd. Would that be?
I think that's getting rarer, fortunately, and you're right to be quizzical about it because it is occasionally appears to be kind of on the margin. Now, arguably, if it's just a refining of forecast by a few percent, by which I mean maybe 2, 3, 4% or something like that, arguably that doesn't require a full announcement because just the quantum isn't material.
And people wouldn't use a research house as against an actual broker to put something like that out.
They shouldn't do if they're being honest with the market. Equally, the analysts may take an industry view. He may have seen comments from other companies in a homogenous sector, and he then might choose to downgrade the peers on the back of the news that's come out of the other company. So a good example might be, obviously retailers or house builders, very homogenous sectors, where the trends that, the first one that reports the trend of falling house prices or falling volumes or squeezed margins, the analyst is going to go, well, actually, I'm going to follow suit on all the other companies. Whether they tell me they're doing well or not, I'm going to just cut my forecasts. And actually, there was an example this week of a client where actually the broker was the top end of the range. One of the peers, close peers, had a profits warning, and they decided that was a good opportunity to bring their forecast down to the consensus.
So other areas there's MAR as well, and can you tell us a little bit more about that?
Yeah, MAR, a lot of this has come out of Europe, and it's kind of a refining of the regime, effectively, which was already in place. But it's just put more onus on the companies and their advisors to ensure the level playing field in terms of the release of information, to the markets as and when it becomes known, and ensuring that companies do that immediately. So the classic example is the profits warning. This is news, you've got to get it out, you can't wait. That's really what MAR's all about, is just that you have to put this news out. One of the issues had been historically, and where the FCA had done some investigations and fined companies before practice, was where they'd known about a potential downgrade, but they'd said, oh, we can wait till the results come out, and then we'll do the downgrade then. And the FCA concluded that wasn't appropriate. They shouldn't have waited. The minute they'd known, they should have got the news out there.
And
so it's really tightening up that whole
Was
issue.
there evidence that there had been trading as though people had known?
No, I think that's the funny thing is I think in 99% of cases there was no evidence anybody traded on it, but it was just the fact that essentially there was knowledge out there which should have been acted upon. And I think the investors that probably complained to the FCA, which led to the investigations, probably just said, we wanted to know earlier, because we might have done something about it then, not now. And it become the compounding of making it worse by delaying it means that actually it then leads to a worse outcome for shareholders.
And has MiFID II affected you as a PR very much?
It doesn't affect us sort of in terms of what we do day to day. Where it's affected the whole industry is the fact it's putting a further squeeze on brokers' research. And it essentially has made it, a less profitable activity for them. It's made it arguably even more competitive for them, and as a result of which they are reducing the amount of research that they are publishing in order to make it more commercially viable. Now that's a disadvantage to companies, and it's a disadvantage to investors who aren't receiving that research. And it doesn't make much difference if you're BP, because you're still going to be followed by 20 or 30 analysts. But if you're a unusual one-of-one type company that doesn't have peers, or you're a small cap, then it's likely to mean that actually you end up with little or no coverage by independent analysts. You're only followed by your house broker, and that's pretty much that. So what it means ultimately is it puts the onus on the companies to pay for research rather than on the investor paying for it, as historically was the regime.
And how happy are companies to pay for that research?
Well, I think companies are still getting their heads round that ultimately is where it's going to end up. That's the model which the regulator has decided in his wisdom, is the model that should be followed. And they view that because they believe it to be more transparent in terms of the way the investors are charging their underlying investors for the services that they provide, which effectively, if you were a member of a pension fund, or you had a life insurance policy, or you were a unit holder in a unit trust, effectively you were carrying the cost of that institution buying the research. That was it. Ultimately, coming off the management charge, which was coming off the value of the fund. So the FCA said, well, that's not right. The underlying investor shouldn't be paying for that. So the onus is on the companies. The companies are getting their heads around that. And I think they're realising that's another cost of being listed. And the issue for them, therefore, is, do we have one broker, two brokers? Do we then pay somebody else as well? Do we have commission research? And you can see it begins to tot up financially. So it is making the cost of listing higher. And of course, the long-term risk, the law of unintended consequences of this regulation may be that less companies list, and remaining a private equity-backed business continues to, should we say, become more and more attractive relative to listing on the stock market when the costs are so high of being on the stock market.
So quite a lot of change there. In terms of the PR function, what's changed over the years since you've been doing it?
Well, it's changed pretty radically. And of course, when I started in '95, it was, the infancy of all the communications that we now take for granted. And, in those days, we really didn't use email, which seems incredible now. And we used to have to fax out in the morning of results, the statements to the press and to the analysts. And we'd also, as a backup, we'd courier to them as well. So we'd have, bikes lined up outside the front door to send these things out. And of course, fax machines, if you go back to the early days of fax machines, they didn't have big memories. So they either just sort of went through page by page, or if it did have a sort of early memory in it, you could probably only load up 2 separate faxes at one time before you used all the memory up. And then, of course, if they were engaged the other end, and you can imagine the newspapers, 7 o'clock on a, Tuesday morning in, results season, their fax machine was going to be quite busy the other end. So that be engaged, you'd never get the fax through. Absolute nightmare. And so the first question that you'd always ask in a press interview on results day is you'd say to the journalist, have you had the announcement? And in most cases, by then, because by then it might have been 11 o'clock, by then they mostly had. However, it was the Evening Standard that was always the issue, because obviously being an afternoon newspaper, they had a much earlier deadline. So that was the one where you really had to rely on that courier to get the announcement to them. Yeah, so completely crazy. So the PR role, the financial PR role, was as much as about being this kind of postman, and it was known as postbox PR because that was kind of what you were doing. And it was, of course, then very much about the press because we didn't have the internet and the wonders of Twitter and all these other channels to consume news. We didn't have 24-hour news channels, with breaking news and so on and so forth. So everybody was entirely reliant on the newspaper for their news. And so newspapers were about recording, the previous day's activities. And it was very important, therefore, for companies to get every bit of news that they announced covered in the newspaper. And the good news was, in those days, the newspapers absolutely recognised that. And so pretty much they would cover everything. And you could get some really quite small announcements for small companies, in the FT, even if it was a tiny little announcement. So that was really what it was all about. Going forward 20 years, of course, it's completely changed. And now it's so much more about kind of strategic advice, the how to communicate, when to communicate, who to communicate to, how much to communicate, all of those sorts of things, the advisory side of it. And it's much less about that kind of post-box activity.
So now you've got a proliferation of media channels, which means you have to be an expert in everything from sort of radio to video to TV to newspapers it's got much more complicated.
It has got more complicated, absolutely right.
And you spend far more time on lots of different things. So how does that work for you, both in terms of skills and in terms of, I suppose you can charge more?
Yeah, well, hopefully, yes. Yeah. Well, it means we've had to rely maybe more on some of those channels because of the diminution of the other channels.
Yeah.
So as the print media has shrunk, and now there are barely any pages on company news in the newspapers at all. And the only companies they follow are, BP and whoever, or companies that are in major crises. They love a crisis. It means we've come to rely more on getting coverage in through other media, whether, as you said, that's broadcast TV, it might be Twitter, et cetera, et cetera. So, blogs that are written by people like Paul Scott,
Yes.
And so on and so forth. So that all of that sort of activities become much more important.
And Twitter and things like people's blogs has made the retail investor far more powerful in a way.
It has, absolutely, because it's given the retail investor access to a much kind of wider pool of information than, one had in the past. And, if I go back to when I started training as a stockbroker, actually, I spent 3 months in our private client department. As it was known in those days, wealth management, as they'd now rather grandly call it. And that was literally, there would be stockbrokers kind of ringing up their clients to say, oh, today we're recommending buying United biscuits. And there's always the joke about the person the other end of the phone replying, oh, what do they do? Which kind of was fairly obvious. So that was kind of the world in those days. And of course, nowadays, it's much easier for people to get that information. So when we say, why don't you have a look at XYZ, we can quickly Google it and hey presto, we may find that Paul Scott's written about it, and there might be a whole stream of consciousness on Twitter from conkers tagging me on 46 tweets on Burford, which I sold at £2, having made a profit. So anyway.
So you are a private investor yourself.
Yes.
What are the constraints as a PR in your own investing?
Well, you'll be pleased to hear that we have a compliance regime, and we're not allowed to trade shares in our clients, to put it very simply.
And is that true for most PRs?
I think it's true for most PRs. I mean, it certainly was true for the firms that I used to work for in the past. The only exception to that is if you already held the shares, then there is not an expectation that you would have to sell them unless the company, having disclosed that to them, said, oh no, we'd rather you did sell them because we see that as a conflict of interest. In reality, in my experience where I have held shares, actually the company said, great, that's great that you do. Sorry you won't be able to trade them anymore, but that's fine. So that's kind of the regime that we're under. And of course it does mean that now and again there are things that you'd like to buy which you're not able to, which is very frustrating. Probably on some occasions that saves you some money as well. But equally it means that there are, you could, for example, look at your favourite investment trust and actually go, well, I might buy that because they've got a big holding in that client, which I think is very good. And of course that is not restricted because clearly the investment trust, isn't the company, as it were. So there isn't that similar compliance issue.
But what do you feel if you hold a company that is a client and you then can't trade it? Isn't that a little bit challenging?
Yeah, that's very challenging.
If you really know bad information's coming out.
You really have to grit your teeth. Yeah, absolutely.
Have you been in that position?
Yes, I have. Yeah. Fortunately, not too many times. And I've also been in situations where I've ended up holding a share for a very long time, just because the share price has just, maybe had a bad time and then taken a long time to recover. And it's been a client of mine for a very long time. So the one good example of that is Begbie's Trainer that had results out earlier this week, which has been a client of mine since, I think I'm right in saying about 2007 or 2008. And I bought shares in it about 6 months before it became a client because I saw the opportunity. And if you look at the share price chart over that longer period of time, it's not been a great performer. It's done very well in the last 3 or 4 years, but I actually held that throughout that whole period. But that's where, of course, the dividends become important as part of your total return.
So if you weren't a financial PR, what would you do?
Well, I suspect I'd probably still be, in the investment banking world, assuming they hadn't got rid of me, maybe redundant, retired me early or something like that. But I suspect if that happenstance of having bumped into this old contact and he said, come and have a chat and have a think about it. And then I had that option of choosing fortuitously between a job offer to go back into stockbroking or move to financial PR. If I hadn't had that, I probably would have taken that job back in stockbroking and I'd still be stockbroking in one form or another.
And if you had that weekend back again, which would you choose?
I think I'd, without doubt, still choose the financial PR. I think I might have been a bit cannier about the money. I slightly rolled over a bit too easily.
Reg, thank you very much indeed.
Pleasure.